Hello, I'm Scott Letourneau, the CEO of NCP and Verified Expansion, and welcome to my U.S. Tax Masterclass. We're going to share with you the key strategies you need to know as an e-commerce seller doing business in the United States. Whether you're a non-resident already crushing it in the global market and you're looking to expand to the United States, perhaps you're already selling on Amazon, you're looking at TikTok, or sell on Walmart. We're going to talk about the strategies you need to know from a taxation viewpoint structuring. If you're a U.S. seller who's already up and running on one of the marketplaces looking to add another one, we're going to talk about U.S. strategies also. We're going to cover some misconceptions that you've heard that's online, I've seen with many different blog posts, YouTube videos, things of that nature. Myself, I'm a U.S. certified tax advisor. I've consulted with many different U.S. tax attorneys on these subjects, and there's been recent changes in 2025 that you need to be aware about that could impact your current structure. Even if you're selling through a foreign entity in the United States and you don't think you're subject to any taxation rules, we're also going to cover sales tax and some of the current issues. Whether you're, again, an existing e-commerce seller expanding, or perhaps you're a new seller looking to get started and launch your business, this masterclass is going to be for you. So let me go ahead and share my screen. We'll go ahead and get started. And this is my U.S. Tax Masterclass, verification traps to avoid when expanding or launching your U.S. e-commerce business. We're going to share with you in a very important case study where we saved one client thousands of dollars in taxation by structuring things properly. This is a common thing that happens when non-residents are looking to do business in the United States. We're going to show you how we cut taxes in half. Let's go ahead and get started. Before I get into all of the strategies today, you're probably a successful business person that's done e-commerce business before. You've probably watched several videos on this particular subject, and you may have talked to different tax professionals. Maybe there's a little bit of confusion, and maybe you feel you know 90% of this. But I'm going to share with you how you can get most out of my training today. This is something I learned from Tony Robbins back at a 1993 Master University event. At this event, he talked about what do the best of the best do that want to learn the most anytime somebody's presenting. So I'm going to share with you that strategy today. So the best learning strategy in the world I learned from Tony Robbins when he was sitting in the front row taking notes to all the speakers is what you need to do is the opposite of what most do. What most believe is I already know that. I've heard that before. So this is what most people are doing. Most people, when somebody speaks, they're like, oh, you're talking about U.S. trader business. I've heard about that before and effectively connected income. Well, I don't have a dependent agent, so that doesn't apply to me. So I'll just kind of doze off here and see what other strategy you come up with. That would be a huge mistake. So that's what most people do. They've heard these buzzwords. They say, okay, I already know what that means. But there's always layers to this. So if that's your pattern in the past, that you do that, and a lot of people do that because they want to sort for what I call sameness. We all want to feel smart that we know something. So like, oh, we heard that, and okay, good, I know what you're talking about, and they kind of doze off. That's going to lead to financial ruin. So if that has been your pattern in the past, going forward, I would offer and suggest to you adopt this new belief system. This is the one I learned from Tony. It takes some energy to do this, and this will be a game changer for your financial ability moving forward. And that new strategy, and what the best believe is, one new distinction will change my entire financial future. Again, one new distinction will change my entire financial future. What that means is when you're with the best of the best, like Tony Robbins, he's listening to the speaker. He's heard the speaker 20 times, 50 times before, but his life changes. So he's saying, what is the speaker saying? How does that apply to my life now? And what is something I've heard maybe slightly differently than maybe 6 months ago? And when I would go to speak at events, when all the speakers would come in the room would be when the speaker at the end of their 90 minutes was going to make their offer, or called the pitch, or sell from the back of the room. And the other speakers wanted to see what did they do differently to get people to buy and move to the back of the room. At the end of the day, they're about adding value, giving their best offer, and there is a skill set to this. Any situation, the best of the best will be asking different questions. Why do some of the best athletes in the world still have coaches? Because they notice little micro distinctions. So the best of the best, when somebody's teaching, they will be listening and asking the question, what can I learn next? What's one or two distinctions I can learn today from Scott that'll help clarify my understanding or cause me to take a step back and have to reevaluate what I'm doing that's going to protect my financial future? So I encourage you and invite you to adopt this new financial belief system. That one new distinction will change my entire financial future. You're going to learn dozens, for some of you, hundreds of distinctions during this training to provide clarity for you. The good news, you can watch it over and over again. Each time you'll hear different strategies, distinctions. So with that, I want to share with you, I'm partnered with some of the best when it comes to e-commerce business, doing business in the United States. I'm an Amazon partner, so we have the ability, when we expand sellers in the United States on Amazon, if they meet certain minimum criteria, we can refer you directly to Amazon. You'll have an internal email to somebody in the inside team. So if you have any verification issues with your FBA inventory, with your ads, you can work with somebody directly inside Amazon. In addition to, if you're working already, perhaps you're working with an agency that's helping you grow your business, this will be in addition to that. We're also Shopify partners, so a lot of people want to attempt to qualify for Shopify payments. It's not an easy task. We have helped people accomplish that goal. Many different tax and legal professionals in sales tax, U.S. taxes, and also getting your account verified and in compliance in the United States. Little legal disclaimer, this is for educational purposes. Even though we're talking about tax, it's not your individual tax or legal advice to you. We recommend you do consult with your tax or legal professionals separately. So the tax traps most sellers miss. We're going to talk about costly hazards to avoid, why your CPA was likely off track, or your accountant professional, or the blog post you read, or the YouTube video you listened to. We're going to talk about the top 10 U.S. tax misconceptions. This is really critical. Each one of these will be one of those distinctions. You want to, of course, calibrate to, did I make any of these? And then what do I need to do to go forward to fix that? We'll talk about some advanced taxation subjects today. Are you potentially going to be subject to double taxation? You may think that's not the case. I'm from a treaty country. There's a new case that came out in the UK a couple months ago that could change all of that for you. So you need to pay particular attention. If you're from a non-treaty country, you absolutely need to pay attention. Selling through a foreign entity, you may be taxed now. So there's, again, a change that's happened. You need to be aware of this change, that your foreign entity that's doing millions of dollars on Amazon, Walmart, you may potentially be subject to tax in 2025 and beyond. If you're selling through a U.S. company, you want to know what works and what doesn't work. We're going to talk about the single member LLC, C Corp partnerships, some of the different issues that come up in U.S. taxation in each one of those. Then we're going to talk about U.S. sales tax. A lot of people believe that it doesn't apply to a marketplace seller. When we talk with global brands doing $20 to $100 million, their brand is important. Compliance is critical and number one for them. So when we get referrals from UK firms, when they're in compliance with all the VAT regulations, they want to know which states still require sales tax registrations, even if the marketplace is collecting and remitting sales tax, because they have to be in compliance. Small sellers getting started, they might have more of a higher risk tolerance. That's a different subject, but we're going to talk about it today, so you need to know what's going on in that area. What about U.S. income tax? How does that potentially come into play? This is critical. We're going to talk about one of the toughest states, California, for sure. Then we're going to talk about our case study, where we're going to look at how someone's structure could be improved to save up to 50% in U.S. taxes. Again, I know a lot of foreign sellers are in the situation, well, I filled out a W-8BNE to my foreign company, and when I looked at the form, it kind of sounded like I didn't have ECI, so I don't have to pay any U.S. taxes. There's more involved in it than that, and I'm going to share with that, so you have to pay particularly close attention in that area. So let me just give you a little quick background to myself. I've been in this business for over 30 years of forming U.S. companies. We've done over 7,000 filings. We do custom work for our clients. Our process is a little bit slower than the online companies. You'll click a button, pay $400, you just fill in some basic questions, and they form an LLC for you. We do an analysis when people come to us about different the marketplaces, the banking, the other requirements, the partners, and before we get all that data, then we make a recommendation, then you approve it, then we move forward and do the filing. So we do much higher end custom work in this area. We've helped protect millions of dollars of sellers over the years. And I personally, when I came out of college, I had a business finance degree, I had a Series 7 license. So that's in the financial markets, of course. So I paid attention back then. This is in the early 90s to the global financial markets, investments, Hong Kong, China, things of that nature all over the world, plus in the U.S., of course. More recently, the last couple of years, I became a Main Street U.S. certified tax advisor through Mark Kohler's group. Been with that group for over 2.5 years, been on hundreds of different Zoom calls with several hundred tax attorneys and other professionals where we look at U.S. tax strategies. 70% of the time, 80%, does everybody agree upon it? But then there's a discussion about nuances, and then it depends on who's, maybe more aggressive. Some people aren't. Level of verification. So when you work with us as a client, that's why we will refer you to the best matched U.S. CPA or tax attorney that fits your situation, and your risk tolerance is very, very important. So I've learned a lot from Mark. He's also done entity structuring for years. I've shared a lot of different strategies, been to their events, and so I bring that to the table also. I'm the CEO and founder of my company, NCP and Verified Expansion. NCP started in 1997. So I've been in the industry for many years. I'm an Amazon agency partner. So as I mentioned, we can refer clients directly to Amazon and work with them. So I've been to Amazon events. This is a picture with Chris McCabe, e-commerce Chris, one of the top guys in the industry of if your account's suspended or an ASIN suspended. A lot of people use templated appeals. They all get rejected. Chris is the guru. He used to work with Amazon, and he's one of the experts when it comes to get your account reinstated properly. That's me and him at the last, that looks like one in an event. We're also at the Amazon event together. I've spoken at many different events over the years. We're also a Shopify partner. That has to do with, should you even attempt to qualify for Shopify payments? What's the operational presence required? Should you go to Stripe? What are Stripe's nuances that require? When do you need an ITIN number? All those things come into play. I've also consulted and worked with MTC.gov on projects on sales tax. They handle multi-state taxation, something called Public Law 86-272 that has to do with when does your company have to register in another state in the United States. I worked with consulting with Deloitte in the late 90s. So when I started my company, we had a lot of companies in the U.S. talked about incorporating Delaware, incorporating Nevada, Wyoming. But most of the audience at the time was to U.S. residents. And the question was, well, if you live in California, do you have to foreign register in the state that falls under what's called the multi-state taxation rules? And I wanted to get the best answer, so I paid $600 an hour to hire Deloitte to go through a series of questions and situations that when do you have to foreign register and maybe you don't. And it's something that there's a lot of misinformation about. There's a lot of over-promising online about. Even today, this day, if you search incorporating Nevada or Wyoming, it depends if you're a non-resident or U.S. resident, and you'll hear a lot of different information about it, and you really have to sift through all these different areas. But I wanted to go to the best of the best to learn the distinctions I talked about, to say, how do they evaluate these situations? And that's where a lot of the training comes from. I've spoken in different countries around the world, in Australia, New Zealand, the UK, on the subject of doing business in the United States, what's required. I mentioned earlier Tony Robbins' Mastery Program in 1993. I've been to several of his UPWs. Yes, I've done the Firewalk over 5 times. It's been a great experience. I love modeling successful people. That's one of the number one things I've learned from Tony. How to reverse engineer, model somebody, ask better quality questions, and get the results. Tony was AI before AI became popular the last couple of years, 30 years ago, about better quality questions and getting results. So I've attended myself over 100 different tax and legal business growth events, J. Abraham, Dan Kennedy, all the tax seminars, trust seminars, e-commerce events over the last 30 some years. So I love to learn just like you, love to learn distinctions and add value to our clients and customers. And there's my beautiful family below. I've been married for 29 years, so I've been in business for over 28 years, married for 29 years, first time in each category. I'd like to say that I've beaten the odds in those things. And so there's a challenge when you have 3 kids, raising them, running a business, working with clients, doing all of that. So I love psychology, the success to make all those things come together. And if you need support in that area, happy to help also. So who is this training for? I mentioned at the beginning, both U.S. and international sellers. If you're selling on Amazon, other e-commerce platforms, if you're doing business maybe in your own name in a business entity, our U.S. Masterclass training will apply for you. So we're going to cover for everybody. Most of it will be more advanced for bigger sellers that we primarily work with around the world, or we do work with well-funded startups that have the capital, that are private label sellers that want to get everything done right from the beginning. We help them also. So here's kind of a key image we talk about when we doing business in the United States and looking at U.S. expansion or starting to launch an e-commerce business is taxes and marketplace verifications will sink you. Most people just think, if I'm going to set up in the U.S., I'll just get a single member LLC. I'll fill out the W-8BN. It'll be simple. And that's not the case. There's been a lot of changes this year with FinCEN, even though the BOI report for U.S. reporting companies had gone by the wayside, not by foreign reporting companies, which means you have a foreign company if you're registered in a certain state. That still needs a report. But FinCEN is still fining banks big time. They fined TD Bank last October 24 of over $3 billion for not following the KYC rules. So a lot of things are tightening up, a lot of verification issues. There's pressure on all the marketplaces. So that's why a lot of sellers are not getting verified, need extra verification. Amazon themselves, when we refer clients to them, they say a new seller getting on board, getting verified, Scott, tell them it'll be potentially up to 2 months or longer before their account's fully verified. Nobody wants to hear that. How is that even possible? Well, Amazon is a slow process. If you don't dot every I, cross every T, and get it just perfect the first time, and you're not verified, it will be a process that easily adds 30 to 60 days to the process. We want to get it right. So in taxation, you see a lot of these areas below the iceberg that most people don't quite understand or they're guessing at. And this is where you want to get more clarity. So this is what we're going to be talking about today. And so the first area we're going to go into is the costly tax hazards to avoid. So if you're selling or expanding into the U.S., here's where most sellers get it wrong. Whether you're U.S. based or international, what would it cost you if the U.S. expansion triggered an IRS audit? And the audits are going to be on the rise, specifically in these areas, or a marketplace suspension, which is crucial. Some people get their account verified, they think they're all good, and then a month later the account is suspended. So you have to do it right from the start. Or what if you were subject to double taxation, which would be, there's even something worse than double taxation I'll talk about, which would destroy any e-commerce business, whether you're doing 5 million or 100 million a year. So you want to pay attention to these various distinctions. So most sellers mistakenly believe that you can start or expand with simple forms, basic LLCs, foreign entities until IRS penalties, verification failures, or double taxation wipes out the profit. Even if you get it all correct, you must quickly determine your U.S. tax risk or pay later. So you want to protect yourself. So I commented about this earlier about the tax and legal mastermind group we work with. You have to determine your risk tolerance. Are you in a low risk situation or a high risk situation? If you're in low risk, no U.S. tax owed, you can file basic returns. Some of you, in a small percentage, will be in that category. Not as many as you think you will be. Some, you're going to have U.S. taxes owed based on marketplace and structure. You have a medium risk. And some of you are going to be in a high risk category, and you're going to have to look at some better planning options. So that's when we get into the area where I talk about how we reduce taxes in half, what that strategy looks like. So it's really critical that you get this right. Now, this also applies to when we match you up. Some people want to be more aggressive tax-wise. Then we have a higher price U.S. tax attorney. They charge more money. They have to represent you in front of the IRS and from an audit. They charge you more on annual tax returns, but you want to be aggressive. It doesn't work I want to be aggressive and I want a low price CPA to do the returns and representing. That doesn't work. So we have to make sure everything's in alignment. So a quick self-check. Are you a U.S. expansion risk? Are you U.S. or non-based? Are you a new or existing sellers? These are some of the questions we ask when you come to us. Which marketplaces or non-marketplaces are you looking to sell on or expand? What type of seller are you? Private label, wholesaler, drop shipping? Does your model or product even require a U.S. entity? Most cases, the answer is no. If you want to go to TikTok Shop, the answer is going to be yes. They want a U.S. company and a W-9. That's not a single member LLC, disregarded, by the way. So all these factors come into play. Are you concerned about U.S. liability? Maybe you have a multi-million-dollar brand in another country. You're selling a high-risk product in the baby niche. You know you can't get insurance in your country. You want U.S. insurance. You know U.S. is famous for suing people for any reason, and you want to separate a U.S. entity to protect your global brand that doesn't have the lawsuits the U.S. does. That could be one reason. Maybe you're expanding to U.S. retailers. I have a friend of mine that their company's products, they expanded to over 3,000 Walmarts in the United States. So that requires a U.S. company and a U.S. presence to make that happen. There's always exceptions, but in generally that's how it works. So are you planning an exit? Now, differently than, obviously, the goal is to have the end in mind. So if you're going to sell a product, your goal is to make extra revenue and profits. At the end of the day, the big picture is ideally, can you do an exit and get a big payday? Get that hockey stick, big curve, not a flat one, a big curve, and your profits are going up, your sales are escalating, and can you get the big payday? So we have to keep that in mind in tax planning, because sometimes what you set up at the beginning works beneficial, but if you do something like an exit later, you're not going to be happy with the results. So you have to take maybe a blended approach. Maybe you have to make some changes, but you got to keep that in mind. That's why you need to get your tax team on board, the U.S. tax team on board, and get the best of both worlds and understand why you're making decisions. So you take accountability. If yes, I knew if we did it this way and we sold our company 2 years later, we'd have an extra tax hit. And of course, now that we did an exit and everything worked out just great, I wish I would have done this differently, saved an extra 20%. But I knew we did it the way we did it, so I understand that. So that's what we're going to do and moving forward. That's somebody who takes accountability, not somebody like, Why did you tell me to do this? Well, okay, remember we talked about it 3 years ago, and you want to do this because it was simpler and easier. So that's really important. These are several distinctions about belief systems, about anticipating what's easier, your cash flow, liability protecting. That's why we take into assessment all these areas. So all these factors are really critical to protecting your brand and profit or exposing it. So you want to do it right. So a couple thoughts about U.S. sellers. So a U.S. seller, most of you are running your business. You might be in whatever your home state is, whether it's Florida, New York, Oklahoma, Minnesota. You probably set up an entity in your home state to sell for your e-commerce business. You could be one mistake away from losing thousands of dollars. So starting a business in the United States in your personal name is like an IRS audit magnet and loss of legal protection. So a lot of people will form just a DBA. They'll keep it simple. They'll end up being what's called a sole proprietorship. It shows up on Schedule C in the United States. That's 15 times, 15x more likely to be audited in the United States. We always recommend sellers, even if they're unsure, they start off single member LLC disregarded. Through the first year, we can elect to make a S election and save a lot in what's called self-employment tax. So we want to do that early, not wait until you have profits. So there's a strategy to do that. So it's critical that some people will go to the accountant. You're not going to make much money. Just get insurance, do business your own name. If you make money, we'll form an LLC tax and S Corp later. So you want to do it properly to save what's called self-employment tax. Now, if you skip sales tax registrations as a U.S. seller, and this is the difference between U.S. and non-resident sellers. In the U.S., if you don't get qualified and register and collect and remit sales tax when you have a liability to remit to the state, and you get audited by the state and they assess penalties and interest, and if you change your address for your business, you never receive that, and you get a default judgment against you in another state, and you go to move your home and you're qualifying for a new mortgage, and they do a search and you have a financial judgment against you, you're not going to get a new mortgage. You're not going to move. Nobody's going to lend you money if you're in that situation because they don't want to see these type of what's called major derogatories in your name. So it's critical. There's some cases where sales tax being behind, the states have frozen bank accounts in Texas in the past. So it's really critical that as a U.S. seller, for sure, because your personal credit, financing, all those things you'd be doing in the United States, that you are in compliance in sales tax. I will tell you, most sellers, when you get the sales tax, will find out they are in fact behind on sales tax. It's not quite as straightforward as it is in Europe, where they have you register for VAT ahead of time. Here, it's kind of, you figure it out. When you determine you should register, get registered, start collecting, remitting, and if we think, meaning the state, you didn't do it properly and we audit you, we'll certainly let you know at that time, which is probably not going to be good news for you. So state tax liens, as I mentioned, can destroy credit and you're not going to get any business loans. Using the wrong personal ID, account suspensions, Amazon, TikTok, Shopify. There's a lot of steps involved. If you try to operate a second account and you didn't get approval, it's going to be a lot of problems. Missing, for U.S. people, there's a lot of opportunities. Put your family on payroll to have families work in the business. There's different strategies, whether, if you have kids under 18, over 18, how to do that in the United States. That's part of Mark Kohler's Tax and Legal Mastermind Group. I have different whiteboards on each one of these strategies that we share with our clients when we do consulting with them. So they could be losing thousands of dollars a year when they don't do this properly, and a lot of people don't. They just get busy. And let's be honest, most people are not paying their U.S. tax advisor on a monthly basis for tax advisory work. They're paying their U.S. tax person to do a U.S. tax return, and they think and they believe because they're paying them to do a U.S. tax return that they should also give them all this tax advice and give them recommendations. Some do a little bit of that, But that's very different and a night and day difference between having a monthly meeting or a quarterly meeting with your U.S. tax advisor to review what you're doing to make adjustments and being proactive. It's like going to the doctor after a year's over and you ate like crap, you didn't exercise, you were drinking too much alcohol, and you were trying to blame the doctor for not giving you health advice, which is not really what the doctor does, right? They're more reactive. So it's very similar in tax. So just keep that in mind. That's one of the big reasons why people are overpaying. And so a lot of people in the United States, they'll hear about Wyoming, right? Wyoming is a great state to form an LLC. And we do that for US residents, same with Nevada. But we have to address, do we have to foreign register, or is it a US LLC for like real estate as the ownership level? And that's different. That's called what's called a charging order protection entity. That may not need to register in another state that doesn't own the real estate. Those things are different. See, again, right there was probably 5 or 6 different distinctions if you're paying attention. You might say, I'm a non-resident seller. I don't own real estate. Do you know one of the biggest reasons Chinese sellers, what they want to do with their money when it comes to U.S., they want to acquire more U.S. real estate through their Amazon business and their profitability. Same with sellers around the world. They're looking to diversify. So real estate is important. If that's an area where you want to park your cash, we can work with you in those areas also. Okay, different tax advice. Why do you get it? Just like going to the doctor, there's generalists and there's specialists. Most CPAs focus in the United States on individual tax returns, a 1040, W-2 employees, independent contractors. They might have a couple corporate clients, couple S-corp returns, maybe a few partnership returns are more complicated, but they certainly don't do expansion in e-commerce or cross-border taxation work. So then, and I've seen this in my tax and legal mastermind group, you get some people that are really conservative if you don't dot every I, cross every T. So for example, if you set up a single member LLC a year ago and you end up making a bunch of profits the last quarter, but you didn't make the late S election, Mark Kohler's group, he has a process that he'll save you $30,000-$40,000 on self-employment taxes by paying the self-employment tax, but putting it on a different schedule and filing a late S election for this year going forward. And if you get audited, they'll explain to the IRS, we missed the election after the year, but we paid all the self-employment tax. And typically for his situation, that's worked out well. Now, that's very aggressive. Most people won't do it. They'll say the year's over, you missed it. So is somebody like Mark or his ability going to be low cost or high cost? That's going to be high cost. And then you have to understand in that situation, which Mark or his CPAs will explain to you, if we go that route and you're audited, guess what? You are going to pay me separately per hour to represent you in the audit. Because what I don't want to hear, and this is what Mark says, is, hey, you told me this strategy will work. I'm not want to pay you to represent me in the audit. So Mark's really smart because he's caught clients on that. And this is about accountability on your end, where he will tell you if there's any hesitation, he will say, Kate, we're not going to do the strategy. You'll pay the extra $30,000-$40,000 in tax right now. And then we're not going to do that. Wait a minute. How come we're going to do that? I want to save the 40. No, you don't, because I just explained to you, you could be audited. There's no guarantees. And I believe my success in the audit will be good. But in order to go through the audit, that's my time. And you got to pay me separately for that time at $600 an hour to go through the audit. Now, maybe that's going to be $2,000, $3,000. We don't know. But it's probably going to be less than 30. But I'm hearing you don't want to do that. Because you don't want to do that, we're not going to go that route. So that's a real world example of the discussion you should expect to have if you want to be aggressive. So I hope you're hearing me. This is about accountability. So when we refer you to the right person, we want to set you up in your situation. You need to know, hey, you're taking an aggressive approach there. Here's who we recommend. But remember, they'll tell you too, if you get audited, don't blame them because you want to be aggressive. So we understand. And a lot of times, like a lot of people are very aggressive with sales tax. They just ignore it. And they just know that, hey, if I get tagged or audited, I'll just pay it at that time and deal with the pain at that time. So some people take that approach. So again, you have to look at conservative versus aggressive U.S. tax traps, delaying S-corp formations. I talked about that. Non-sellers. Assuming a WABN means I don't have to pay any U.S. taxes. They have no permanent establishment risk because I don't have any U.S. dependent agents. Sales tax blind spots. Most auditors miss the multi-state sales tax compliance completely, especially with marketplace. They're like, oh, Amazon collects. They've been doing it since 2019, 2021. I think 23 was maybe one of the last states that they started collecting for. Risk tolerance, reality. So you must decide if you're protecting $1 million brand or launching your first private label product. So you have to look at what's your risk tolerance. You might be a new seller, cash flow is a little bit tight, and you're younger, you have no family, no assets, you probably have a higher risk tolerance. If you're my age, you have a family, kids, in college, finishing college, you're established, you have equity in homes, investments, your risk tolerance is probably going to be less. A lot of people think rich people, multimillionaires, billionaires, they're more aggressive. Those guys have more attorneys working for them to review every financial decision, trying to anticipate how they don't lose a dime of their money, because they know the blood, sweat, and tears they did over 30 years to build it up, and the hundreds of hours of working, the missed events, and all the stress, and they don't want to give it away to all the freeloaders out there that want to sue people in the United States and blame others for lack of accountability. So that's just my position on it. So you have to be aware of how that works. Okay, so let's get into one of the biggest misconceptions and talk about how people are at risk, which is this subject: are you engaged in what's called a U.S. trade or business? So it's a big U.S. tax question. The answer is the term U.S. trade or business is grounded in IRS Code 864B and further interpreted by Treasury Regulation 1864-2 and extensive case law. So I'm not going to read all the IRS terms. I'm just going to show you on the screen. There's lots of them. Facts and circumstances span both the entity and its principals, that means owners, key regulations, again 1864, again with the dash 2C says fixed place of business. There's one for inventory and there's one for services. So there's 3 different regulations around this. The owner is a resident of an income tax treaty country. A further permanent establishment, you'll see permanent establishment initials PE test applies. Form 8833 must be applied to claim the treaty exemption. If you're engaged in U.S. trade or business, you have ECI. If you have a permanent establishment, we'll talk more about it, that overrides the treaty, and then you're definitely in a tax situation. So the determination requires an analysis. It's not, I'm selling Amazon FBA private label, am I subject to U.S. taxes? It requires an analysis. It's not black or white. I know you want it to be black or white. It's not. That's why you get some tax attorneys say this way, some say this way, and some are more aggressive, some are really aggressive. Some are really aggressive because they just look at the audits and there isn't much, so they go that route. But again, if you're doing a couple 100,000, the impact may be minor to you. If you're doing 40 million in a major brand, the impact is different, right? So U.S. trade or business analysis, a U.S. LLC or foreign company, if its activities are considerable, continuous, and regular, and those are 3 words you'll hear about doing business here. So for example, if you just, there's some business in the United States that just do business around Halloween. They open up a big haunted house for 6 weeks around Halloween and they close it down. They do business once a year. Well, that's not continuous throughout the year. Now, most of you that doesn't apply because you're selling continuous throughout the year. So where do these terms come from? The 3-word test is a case law shorthand in tax court IRS rulings, sometimes used when they summarize why a foreign taxpayer's activities rose to a U.S. trade or business. It's helpful as a teaching pneumatic, but it's not the operative language of the regulation. So I use this, you'll see this in print on our website. It's kind of a frame to use. It's not the detailed regulations, but it's a starting point to determine this, if that makes sense. So what do the regulations actually say? 1.864-2 breaks it into 2 principal gateways. So you have one that's called the fixed place of business. The taxpayer or its inventory is located at regular use physical place of business, states that is regularly maintained or occupied in carrying on the trade, U.S. trade or business exists. So you have fixed place of business, then you have dependent agent with contract authority. This is where you hear people say, do you have a dependent agent or not? If a U.S. person habitually exercises authority to conclude contracts on behalf of the foreign taxpayer, U.S. trade or business exists even without premises, meaning the fixed place of business. These two avenues create the bright line U.S. trade or business status. The continuous, considerable, regular phrase is simply how courts describe facts that satisfy one of those two gateways. Why do you get different answers? Domestic 86.4 rules, inventory-based. Treaty Article 5 is activity-based. Fail to separate the two leads to mistaken no U.S. trade or business opinions. So here's more detail on it. I won't read through all of this, but this is the three-prong that goes into the fixed place of business, the key trigger for an Amazon seller, any physical premise regularly used or maintained, why it applies to FBA inventory stored for U.S. sale in a warehouse is deemed a fixed place of business under 1864-3C. No need for employees or at least possession available to delivery is enough. Dependent agent without a contract. This is rare for FBA sellers. Amazon itself is an independent agent. The prong is irrelevant once the fixed place test above is satisfied. Personal services, common, but we don't even have to reach it with inventory. So takeaway inventory equals premise. The absence of dependent agent does not rescue a foreign FBA seller once goods sit in a U.S. fulfillment center. So that's how we kind of get here in this area. Key point takeaway, inventory equals premises. The absence of dependent agent does not rescue a foreign FBA seller once goods are in a U.S. fulfillment center or a U.S. company, single member LLC disregarded. So we have to go even further. Why? The no tax, no return view collapses for FBA. Domestic law controls first. So we get this regulation 1864-3C example. Treats inventory held for the sale in the United States as an office or other fixed place of business. Single fact creates U.S. trade or business. And effectively connected income with ECI, it overrides that too. The treaty overlay is optimal, requires the filing. So we'll talk about a single member LLC, most common, disregarded. In a moment, the owner is a treaty resident that may override the domestic result only by showing the warehouse qualifies as storage for delivery that is preparatory auxiliary under Article 5.4. In filing Form 8833 with the protective 1040NR or 1120F. So a lot of you are in treaty countries. This is not a problem if you file the right returns, still no tax owed. You're in a good situation. A lot of people don't file the returns and could be audited. That's a problem. So decision tree for non-resident Amazon sellers. Is there any inventory located in U.S. to third-party warehouse? Yes. U.S. trade or business via fixed place rule, ECI, 1040NR, 1120F treaty. Relief only if there's a PE exception. So what I'm saying, if there's a PE, then you're going to owe taxes, but you get relief from Form 8833. That last part probably could have been laid out a little differently and put the PE at the end. So if you don't have any of this, you go to step 2. Is there a U.S. office, return center, dependent agent that materially participates? If yes, then you're back to U.S. trade or business. Most people are attempting not to do this. Sometimes this comes into play when you need a U.S. office, like a non-CMRA for banking purposes. So we consult on that. What are the different options there? What are the different requirements? How do you get a non-CMRA address? Maybe an office, utility bill, but hopefully still don't fall into the U.S. office category in the second area, correct? So if there's still none of this, you go to step 3, result. If you don't have the inventory situation, you don't have the office, there's no U.S. trade or business, income is just foreign sourced. So then if you had a single member LLC example, disregard, that's where you just do Form 5472 and Pro Forma 1120, no individual 1040NR, or if it's single member LLC owned by a foreign company, no 1040NR with 8833 from a treaty country, and if it's owned by a foreign company, then no 1120F with the 8833 if you're from a treaty country. We'll talk about non-treaty countries in a couple minutes. So the global shift, this is the big problem that Everybody has. This is a major problem. The OECD, and I'll tell you what that means in a moment. And this was April 2025 in a UK reform. You might say, oh, that's in the UK. What does that have to do with the US? We'll get to that in a moment. So what is OECD? It is the Organization of Economic Cooperation and Development. There's a 38-member international body setting global tax norms. So this is the people that say what's happening globally. Focus on preventing profit shifting and ensure taxes paid where business is actually conducted. And this is exactly what you're trying to do, is to shift profits. And some people are like, they're like, well, on one hand, I'm not doing business in the United States, so I don't want to pay tax there. On the other hand, I'm not really doing business in my country, so I don't want to pay tax there. I want to be in no man's land and constantly be moving around the world, not paying any tax anywhere. Now, are there legal ways to do that? There's a lot of hoops to jump through, yes. But in a general sense, this is what the OECD wants to eliminate is, hey, you're doing business there, pay tax there. If you're not doing business there, you must be paying tax over here, so let's pay tax here. None of this not paying tax anywhere stuff, unless you're in a country and you're a resident that pays low or zero income tax and you live there. That's a different subject, of course, right? So what happened in April 2025? The UK codified these aligned rules on permanent establishment. This is a problem. Remember I said, oh, this is all fine, do the right returns, not an issue, except if you have a permanent establishment. Oh, this is fine, just do the 1040 NR 8833, except if you have a permanent establishment. So this is looking at permanent establishment, which means you may now be owing taxes. And also what's called transfer pricing of financial transactions. You hear like transfer price rules. Oh, I have a U.S. corporation and I have a corporation in Hong Kong. Hong Kong company is going to be the agency. It's going to provide services. We're going to expense out money of the U.S. to lower the U.S., so I don't have to pay as much tax at 21% tax rate and lower it. That gets into that category. So you got to watch that too. So it signals deeper EU alignment with these rules, right? Now, other countries, Germany, France, Canada, Australia, are enforcing similar rules. So you might say, what does that have to do with me in the US? Well, let's look at the impact. So if you are a non-resident selling, Amazon FBA in the US, you own inventory, it's stored, you control pricing, listings, returns, you use platforms like Amazon, TikTok to fill services, you may have now potentially a US permanent establishment as this trend is spreading. And we anticipate the US being on board with this. So we have to look at, you may. I don't say you will. Can't say audits are starting next week. This is a trend, and this goes from FinCEN, what I said earlier, it goes with banking, it goes with, okay, most people are going to tell you an insider tip that I do during consulting. When you set up a US neobank or transfer agency, they're asking, where is the business located? You're all, the ones who set up single member LLCs disregarded, are confused, thinking the business is located in the US when you're really doing the business in your home country. That all relates to what we just talked about. It's all coming together. No longer are you going to be able to get away with a $10 US virtual address. You may be getting away with it now. What I mean is audited a year, 2 years, 3 years, and have to pay a massive penalty. It's not just going to be that simple. It's just not going to be that simple. And obviously, most of you sellers are operating through a foreign company, and that's a concern. Or if you set up a U.S. company, you're not operating through single member LLCs disregarded owned by foreign individuals. Okay, so what's a permanent establishment? We should probably take a little closer look at this. PE, you'll hear that often. Under most U.S. tax treaties, it's a fixed place of business through which the business of an enterprise wholly or partly carried on. It may include a dependent agent who habitually concludes contracts or plays the principal role in concluding them, a warehouse, office, return facility used beyond auxiliary purposes, meaning your own. Examples: when you likely have a PE in the United States, foreign company has a U.S. office or employee. And I know in the moment you can think, oh, that's not my situation. What about TikTok Shop? Oh, I need a U.S. primary business representative. I got my friend to do that. Could that potentially be a U.S. employee or officer? Well, did you have the correct agreements? How did you pay them? What were their responsibilities? Are you aware of the changes in the U.S. rules on independent contractors versus employees the last couple of years? Again, it all gets down to how do you defend yourself in the audit? Who's representing you? What is their skill set and confidence? That's going to be triple the cost versus the basic person doing returns. So I'm sharing with you worst case scenario, which you don't want to bury your head in the sand, so you can reverse engineer. How do you protect yourself? So you think through these things from a strategic viewpoint. U.S. sales-based agents closing deals. Is that an affiliate? Is that one of those 1,000 affiliates you have in TikTok Shop? Probably not. They're contractors. Would I pay attention to that over time with the MTC Gov that I talked about earlier? Yes. Is that a concern? Probably should not be. That would be logical. Could it turn into one? That would be disastrous, right? Does it mean you shouldn't do that and have, people on TikTok? Does it mean, is there a way to avoid all of this? Yes, there is. It depends how you structure things. So keep that in mind. Then we have to look at, foreign company owns inventory, US LLC disregarded, PE, different things like that. So I'm going to speed it up a little bit so we have a lot to cover. I just want to make sure you got the foundation. So you have visibility of the IRS. Depends on more than just you fill out a W-8. It's not true that all foreign sellers are invisible to the IRS. What matters when you're taking the steps to create IRS traceable footprint, such as obtaining an EIN, especially tied to U.S. entity. Some foreign companies need to get a resale certificate. You might have got an EIN for that. You might have been registered for sales tax to file zero returns. Filing forms 1120F or 8833, even if they're protective, comes into play. Registering for state sales tax, right? Filing form 5472 with pro forma 1120. So these are all things you could be on the radar screen for. U.S. tax misconceptions. Let's go through the big 10. I filled out a W-8BN or W-8BNE, so I don't owe any U.S. tax. This is an issue with Amazon, and Walmart doesn't do it this way, by the way. The W-8 is an information form for withholding purposes only. Withholding. There's something called FDAP income we'll talk about in a little bit. Most of you don't have any U.S. FDAP income. You might if you have royalties, but we'll talk about that. It does not determine whether you have effectively connected income or a U.S. tax filing obligation. Even though the form, if you read the boxes on it, it'll say, I don't have U.S. ECI. It's very misleading. My W-8BN says I don't have ECI, so that settles it, right? That's what I said. Whenever you have ECI, determine you have tax, not what you checked on W-8 form. W-8BNE means I'm not engaged U.S. trade or business, even with W-8BNE owning inventory, U.S. typically creates ECI. So same kind of, so that's all the foreign entities. Amazon doesn't ask for W-8 ECI, so I must not have to fill out U.S. returns. Amazon tax interview doesn't control your U.S. legal tax obligations. By the way, the Amazon tax interview is like hard-coded, and it overrides the business application. That's why so many of you get frustrated, set up single-member LLCs disregarded, and you want to appear as a U.S. company to increase your sales because the U.S. awareness of let's buy from U.S.-based companies, different than buy American-made products, of course. So I know it's a frustrating point, but it's hardwired. It's all due to the Inform Act, all due to this tightening of enforcement with all the things we've been talking about. So it's frustrating. Yes, I actually have a message for Amazon where they admitted it per se, but it ain't going to change. So number 5, I don't have a U.S. office or employees, so I don't have a permanent establishment under the OECD alignment rules we just talked about. That's now a potential major issue. Number 6, I'm a foreign company, so I don't file U.S. tax returns. You have ECI. You you should file 1120F. We're going to talk about if you don't, even if you're from a treaty country. The IRS and the banks That's what the BOI reports were about in the US, to find out who all these foreign owners are, money laundering, how to stop this activity, how to know who owns all these US LLCs. That's what that was all about. So that's critical, and that's what the discussion was about. Yes, it's set aside for the moment, but that doesn't mean the FinCEN is still not operating, which they are. Number 7, protective filing is optional. I'll wait till the IRS asks. If you don't file a timely return, this is critical. You lose all deductions and may be taxed on gross receipts. So imagine doing $1 million a year on Amazon and you made 10% profit, 100 grand, but you didn't file protective returns, and they said you don't get any deductions. We're just going to tax you on $1 million as if you made $1 million of profits. You would probably go bankrupt after that. So that's a problem. Number 8, branch profits tax applies to large corporations. Any foreign corporations with a U.S. permanent establishment, and ECI may be subject to branch profits tax regardless of size. This is up to 30%. Yes, in some treaty countries it's reduced, but you need to be aware of it. If you're from a non-treaty country, such as Hong Kong, well, then it's the full 30%. That's a major problem, so you have to be aware of it. You might say the 2017 Tax Cuts and Jobs Act doesn't affect me. The corporate rate was lowered to 21%, making U.S. corporation more attractive, more efficient. So that is true. We're going to talk about the Jobs Act a little bit more, what actually changed. Number 10, selling through Amazon or TikTok is passive, not a real U.S. business. Meaning they're doing it all for you. If you control listings, own inventory in the U.S., and use fulfillment service, you're operating a U.S. trade or business, potentially with permanent establishment, as we talked about. And I know we already covered some advanced subjects. We're going to dig even deeper here. Why double taxation may occur. You have a U.S. single, let's say you have a U.S. single member LLC owned by a foreign individual. Common in drop shipping, where you need to work with U.S. retailers, things of that nature. You're taxed on your LLC profits as earned income in the U.S. You assume a PE or form you're from a non-treaty country, so no 8833 at the 1040 NR. Your home country taxes the same LLCs as a foreign dividend, right? So that is where double taxation comes into play. So let's assume you have a situation here where you were selling on Amazon, you have ECI, but you're from a treaty country. If you didn't file Form 1040 NR and 8833, and they audit you, and you thought, well, I didn't need to, then you're going to have to pay tax on that. Now you pay U.S. taxes. Well, in your home country, if they treat that tax you paid, you may not get what's called a foreign tax credit, because some countries will treat the income from the U.S. LLC as a foreign dividend. Now, maybe it might be at a lower rate, maybe not 30%, maybe it's 5%. A couple countries it's 0, so it becomes a non-issue. But if it's 5% and you pay tax in the U.S. at personal rates plus the 5%, you are now quote-unquote double taxed because they didn't offset each other. That's how this could come into play. Or if you were from a treaty country and you had a PE, that's a problem, and you didn't pay tax, and you just, you thought you were protected by the treaty. So these are some concerns for you that double taxation could come into play. So no foreign tax credit. So 2 taxes, no credit, double hit. That could come into play. Now, obviously, you have to look at the overall blended rate. How does it come into play? What does that mean for your situation? Now, what's a hybrid entity? You might hear this term online. It's where an entity is treated basically one way in one country, another way in another country, 2 different tax systems. U.S. may treat the LLC as a transparent, disregarded entity. Your home country may say we don't recognize, disregarded entities. So an LLC to us looks like a corporation. That's a hybrid entity. It creates a tax classification mismatch when cash is distributed or taxed. Examples: single member LLC taxes Schedule C income at 1040 NR. Home country sees the payment as a foreign dividend. Bottom line, hybrid mismatches create reporting confusion, possibly double taxation, or denied tax credits. Now, there's some rare instances where people are not paying tax in the U.S. and then the dividend is taxed at a zero rate, so they're not paying tax in their home country, so it works to your advantage. Those are getting less and less. Selling through a foreign entity, this is going to be a majority of you listening, and you need to pay attention because you may have been doing this for years and thought no big deal, but we got to look at these changes. So selling from the UK, we'll do that as an example. You still might owe US tax. Let's say you're using a UK limited company, you're on Amazon or TikTok Shop. Now, we know TikTok Shop, you can sell on TikTok Shop in the UK through your UK entity. If you want to sell through TikTok Shop in the US currently, it's may change in the future when it's sold or acquired. You need to fill out a W-9 like Walmart. So you have to form a separate US company. The UK limited company is not going to work for that. So this creates US tax exposure even if you don't have employees or an office. Why? Because of the new rules in the UK that could potentially create a permanent establishment. FBA inventory, we talked about US trade or business and effectively connected income that relates to tax exposure. So if you want protection, you got a minimum file 1120F. If you're a corporation, if you're a foreign individual selling, or you do a 1040NR, claim treaty benefits from 8833 if you're eligible, right? That requires US EIN. That requires, putting your toe in the water with the IRS system, meaning that some people say, I don't want to trigger the IRS even to look at it, so I'm just not going to do this, and I filled the W-8BN. Long story short, there's going to be a problem and you have to assume with these new rules tightening that at one point in the future, the IRS will audit Amazon, ask for all the W-8BNs and the W-8BNEs, and take a look to see who filed these protective returns and claim treaty benefits or not. It's a sitting duck that's coming. So skip the step and you look what happens next, why most sellers never see it coming. Skip the 1120F. Now it equals gross tax, no treaty, no protection. The IRS doesn't care if you meant well. No 1120F, no deductions. You can be taxed on gross revenue, not profit. Form 8033 only protects you if you file it on time with Form 1120F. Miss the deadline, you lose tax deductions, cost of goods sold, shipping, Amazon fees, treaty benefits, foreign tax credit eligibility in many countries, all the things you lose. Then there's the 10% compliance failure can become a 100% tax penalty. Most foreign sellers don't lose on tax, they lose on paperwork, and I should say strategy and being up to date on these items that are critical. When selling from a foreign company stops working, you're hitting verification walls, TikTok Shop, Stripe, Walmart, your bank account may rejected, you set up things we just spoke about. You're holding U.S. inventories triggers U.S. tax exposure. Treaty protection only applies if you file correctly. You're scaling. Now you need a cleaner U.S. presence for branding, wholesale partners, agency relationships. You want legal separation, platform trust, and control of your U.S. tax planning. A U.S. corp or properly structured LLC may give you the clean separation, credibility, and protection your business now needs. That transitions to selling through a U.S. company. What do we need to take a look at? What are some of the concerns? What are the risks? And what do you need to do? So again, you're learning dozens of distinctions, hopefully some more language patterns to clarify some misconceptions. Let's continue with some more. So just keep in mind that we get a lot of referrals from international accountants that have clients that want to expand because they want to understand more of the tax strategy before they set up a U.S. entity, before they choose the right address, before they know which banking transfer service they go with, before they decide how the entity is taxed, and before they go to which marketplace. They want to reverse engineer all of that. It's almost impossible to get all of that in one-stop shop unless you work with us, because we understand all these factors. And that's why we get so many people that are referred by foreign tax professionals. So in the U.S., when you talk to an accountant, they keep it simple. It's how we got into sales tax registrations back in 2015. because we had big sellers that were promoting marketing opportunities, how to make money online. And they were asking about sales tax, and they asked a bunch of their CPAs, and at times it doesn't Amazon collect sales tax? And they're like, they don't. So when do our sellers need to collect and remit sales tax? At the time, you had TaxJar, Avalara doing business in this area, but it wasn't really a good education process. And they came to us and wanted us to, hey, can you kind of explain it step by step before they get to the software? What are all the variables? And again, that was triggered by some of the CPAs. And we work with some very good ones, but we also know some specialize in real estate, some specialize in small business. They're all not the same across the board. So when it comes to Amazon, TikTok Shop, Stripe, you need W-9, clear business ownership. They don't understand how some of these work. So you're going to get advice from a tax point of view that may or may not be accurate. I've always shared with you why some of that may not be accurate. Most CPAs don't understand this part, which is going to change the structure. TikTok Shop, for example, they want to verify you through the IRS like Amazon does, but they take it a step further. They want to verify the address you used with the IRS, that it matches your account setup. And a lot of people don't understand that, and they do the SS4 wrong, and that really slows up the process. So your entity fails before it even starts in a lot of cases, just relying upon the CPA and what they're doing. Not all of them. I don't like to make generalizations, but a lot of them are not aware of these things other than general. Yeah, I got a few clients on Amazon, a few clients that do Shopify, and they refer them to Avalara. That's about all they know for sales tax. So this isn't just about taxes, it's about matching your legal structure to the marketplace. So why US LLC? And just so you know, a US LLC can be taxed in 4 different methods. I'm not going to go into all that. I mean, basically S Corp, C Corp, partnership, single member. S Corp doesn't work for non-residents. So, and there's a breakdown of each one. What I meant, I won't go into all of that, but those are the 4 options. So for non-residents, single member LLC, partnership, or corporation are the 3 options. So you want the Amazon seller profile page to show the U.S. business entity, not a foreign entity. So for some of you, this may be a big deal. For some of your products, some of your product categories, some of your niches, this may become more of an issue. You may be losing more business to, U.S.-based companies, certainly products that are made in the U.S. Because of the tariff war and all of that. So this is a heightened situation that in the past when consumers, including myself, years ago would buy an Amazon, never looked at the sold by line. Who am I buying this from? We know most of the products are manufactured in China, but we still, maybe we want to buy from a U.S. company, not a Chinese-based individual or a Chinese-based company. So more and more U.S. consumers, especially with the new president, are becoming more aware of this, and they're looking at, who am I buying this from? If there's 3 listings, they all look the same, reviews about the same, prices about the same, I'm just going to pick the U.S. company. That may not affect your transactions. Of course, you're not going to know until you split test, and it's really difficult to split test it. So you just have to kind of know what's happening in your industry. So TikTok requires W-9. That's an example. Working with U.S. suppliers for domestic invoice. You're expanding. U.S. platforms like Amazon, TikTok require U.S. entity that can pass verification. I'm not saying Amazon requires a U.S. entity. Obviously, you can sell from a foreign entity. But if you want the U.S. company to be based on the seller central page. Now, some countries like UK, where you have a limited, we actually do have that ending in the US. It's not common at all. I would say 95%, maybe it's 98% of the companies have either LLC or Inc. on them, not LTD, but it is a possibility. So that's something that potentially somebody might think it's a US company when it's actually not. LLC unlocks what your UK limited company can't do. Compliance, trust, access, right? May help conversions. It's not about taxes, about functionality. Without the right structure, you're stalled before you start. So 3 US structures. We've filed, fixed, or rebuilt. We get a lot of people come to us. We have to review what they did. They thought they'd take a shortcut and get it done quickly online. We have to review it, look at it. The IRS, you can't amend the IRS SS4 application for taxes, but you can submit a form which takes a couple months to update addresses, things of that nature, which may come into play. It's much easier and faster if we just do it from the start, but we end up fixing, amending. Sometimes we just tell people, let's just start with a new one and dissolve the other one you did. So you have US C Corp, LLC taxed as a C Corp. Those are the two in the C Corp category. Just know that from a tax point of view is the same result, C Corp. But you can form a corporation or form an LLC taxed as a corporation, files the same federal return. Cleanest for verification, simplest for FTC alignment for the Federal Trade Commission. US LLC partnership works well for spouses or co-owners, more complex tax filings. A lot of times we talk to people that, I have a partner. Okay, well, that doesn't mean we automatically need a partnership because maybe your partner's to a UK limited company, and the UK limited company might own the US company 100%. Maybe it doesn't own it at all. Maybe it's a separate company. Maybe it could be an LLC tax C Corp owned by the two foreign partners. Maybe it's a partnership. Maybe the partnership is 95% your UK company and 5% one of the partners. Maybe each of the partners own 2.5%, 95% by the foreign UK company. So there's structuring that has to be done there. Just keep in mind. US single member LLC is disregarded. Okay for platforms, but the owner individual must file. So the single member LLC, if you had ECI, you would file the 1040NR, the 1120F, and the 5472 for that. So then, of course, you're treated the 8833. We'll get more into that. So that's kind of a basic outline. All right, I had in the next line. There we go. So U.S. tax filing requirements. We talked about the 1120F for foreign company required for foreign company. Form 8833 if you're from a treaty country. 5472 pro forma 1120 for the single member LLC. These forms preserve your rights. If you miss one, then you may owe tax on gross income if they audit you and say you should have been not only filing the returns, you should actually have been paying taxes. So that'd be worst case scenario, right? So single member LLC disregard owned individually or by a corporation. Single member LLC, as we said, very commonly known, files 5472 pro forma 1120. This kicked in the year 2018. If it's owned by a foreign corp would do 1120F plus 8833. If it's owned by a foreign individual, they would do 1040NR plus 8833. Must be filed, of course, on time. The IRS can't tax a foreign entity unless you trigger a PE, permanent establishment, defined in the treaties, not in U.S. tax law. A fixed place of business in the United States, we talked about this. If you trigger it, the IRS gets taxing rights, even if you're a foreign country. The risk, you owe tax on profits, possibly branch profit tax. I mentioned that before, from 5 to 30%. Could be reduced by your treaty. You don't want permanent establishment. Again, what most don't know is what we already talked about a few times is these new guidelines of the 38-member board, the OECD aligned rules. But it's easy to trigger one accidentally. So we talked about some of those situations where you hire somebody, is the TikTok shop primary business representative? Could they fall into that situation? Could you set up a U.S. office? Those type of things, right? U.S. sales tax. Again, if your thought to your brain is, I'm an Amazon seller, I can doze off because Amazon collects. That's wrong. We talked about distinctions. You got to pay attention because states are looking at this, especially California, Washington, Illinois. You thought tax was done. Welcome to sales tax. So think you're done once you file 1120F, claim treaty protection. Not quite. Federal tax is your income tax risk, but there's another level of tax that treaties don't cover. Every U.S. state has its own rules, and they're coming for you for sales tax. Unlike VAT in Europe, for example, sales tax in the U.S. is state by state. So we're the only country in the world that does it state by state. It's much more complicated. It becomes much more difficult. That's what we tackle next. Okay, so marketplace sales tax does not equal no risk. Most sellers think they're safe, but they're still exposed. Marketplace collection doesn't eliminate your responsibilities. There's about 14 plus states that still expect you to register and file zero returns. I know that sounds crazy, but they'll either look at physical inventory through FBA, or if you cross the economic nexus threshold, there's different rules, and say, We don't care if you cross that. We want you to file zero returns and let us know what the marketplace is collecting on your behalf. And there are late fees if audited for some states. Then some states, like the state of Washington, have something called the B&O tax. There's franchise fees in Texas that are outside of the scope of what Amazon collects, and they're small percentages. But again, different if you're doing 500,000 a year, if you're doing 50 million a year, right? Major difference. TikTok, Walmart, Etsy, same deal. They're all marketplaces. Just because they collect sales tax doesn't mean you're covered. So here's a little chart of some of the economic nexus thresholds in different states. This is especially important. We'll talk about Shopify sellers that are selling on your own website. Did you cross these thresholds? And even some Amazon states. Some states, a lot of them were 100,000 in sales in that particular state, or 200 transactions. We're the only country in the world that had transactions, which is really a bad rule. The good news is over the last 3 or 4 years, there's been about 8 or 9 states that have dropped and said, you know what, we should just look at 100,000 sales in our state. So if California says 500,000, that doesn't mean you do 500,000 sales nationwide. That means you did 500,000 sales in California. Then you would cross what's called the economic nexus threshold. And to give you an idea, if you sold a product and you looked at California's population, which is about 13.5, maybe it's 13 or 14% of the total U.S. population, you probably would have to be about 6 million in sales before you might cross 500,000 sales in California. But there's another rule in California you have to look at. We're going to talk about that you could reach that sooner. So we'll take a look at that. So if you add Shopify, so a lot of people, they're crushing on Amazon, TikTok Shop, Walmart, and they want to, sell their products on their own website, set up a Shopify store. It's 5% of the sales, but it triggers a big sales tax responsibility. You can minimize that by how you structure things, but most people don't think that far ahead. They don't get advice. They don't take a step back and look at that. They just add it along to keep it simple. So if you're selling outside a marketplace, you got a full compliance burden. You now must register, collect, file, and remit. Every state with economic or physical nexus, software registration penalties, it stacks up fast. No more hiding behind Amazon or Walmart. This is when sellers get serious or get in trouble. So marketplace creates risk, but non-marketplace multiplies it fast. Both matter. One just hits harder. Most sellers ignore the marketplace filing rules and hope for the best, but adding non-marketplace like Shopify, your own website, that's an audit magnet. States now have data sharing tools, nexus thresholds, AI enforcement. You hear the word AI. They go to seminars too, They're there to raise money for their state, look good so they keep their jobs, and they're looking for people who aren't paying sales tax, have thousands of reviews. It's not that difficult to scrape software and then send a letter, and it goes to some address. It doesn't forward it to you. You don't respond. Then it gets worse from there. Smart brands build compliant foundations before they scale. So behind the scenes of real compliance, you could try to figure this out yourself. Here's an internal guide that we use with our clients that we work with in this area. This is one of our spreadsheets, and it goes through the different economic thresholds of all multiple states, when is registration required in different situations, what's the fees, the process, the default, the penalties, registrations. Here's a little closer look at some of these factors that we have to look at. When do you register? When do you not? What do you include in sales? Most sellers skip that, and that's where the audit starts. Thresholds vary by state, filing frequency. Some states demand zero returns, even if you owe $0. We talked about B&O in Washington, physical economic nexus. You got to figure all this out. And there's some very good sales tax software does it proactively. We work with some SALT firms on this that will do a sales tax nexus study and all these things to get in, and they charge per state. Then they get to the software or registration or management of everything on the back end. Everyone else gets caught later who doesn't do it right. California loans, $800 for just a franchise tax bid. It has nothing to do with just the penalties on the sales tax. That's just a fee for not being in California. You do not want the California Franchise Tax Board coming after your brand, that's for sure. If you want this spreadsheet. This is something we do screen shares when I do strategy calls with clients, and you'll get to see the details on it. Okay, so Shopify, we talked about that. You have to look at the economic nexus thresholds. We talked about several states, 100,000 in sales, not a big 200 transactions. What if you sell a $10 product that's only $2,000 in sales? You cross the threshold. Some states you got to register immediately, some the next month, some the following quarter, some the beginning of the year. It varies. Now, the number is 22. It'll probably drop in the next 12 months, maybe below 20. Because more states are realizing this does create a burden to look at all these returns that are filing zero returns. Maybe that doesn't make sense as far as cost of labor. So that's good news. Texas, California, 500. First, find out, are your products subject to sales tax or not? Because some are not subject to sales tax. More complex are things like supplements and clothing. So you have to figure out, do you have nexus? When do you register? You got to collect. Then you got to remit, means give it back to the state. You're basically an unpaid affiliate, and there's a lot of compliance risks to do this, and that's how it works. So if you add both Marketplace and Shopify or non-Marketplace, don't trust the Shopify sales tax tool because it doesn't combine Marketplace, meaning there's about 18 states that combine for economic nexus purposes. They'll combine your marketplace sales and non-marketplace sales. So let's say 95% of your sales are on Amazon and 5% are on Shopify. Well, they combine those to determine if you cross the economic threshold, and now you got to collect and remit on your small amount of Shopify sales. The Shopify tool will not pick that up. So if you're behind on sales tax, you never collect or remitted. Good news, this is very common starting out. The bad news is getting into compliance ASAP is a bad idea. Now, there is certain risk tolerance. Sometimes we will say, is it material? Do you owe $50 in past sales tax, penalty, interest? Not a big deal. Is it $200? Maybe not a big deal. Is it $500? Well, is that material to you times 20 states? Maybe not a big deal. It depends. You do $2 million a year, whatever. Do you owe $1,000 per state? No. Well, maybe that's material. Maybe we need to get registered. Then how do we do that? Do we file past returns going forward? Do we pay the past sales tax on future returns? Do we not? Is that a risk? How do we do it? Those are things we consult at. Then we place you with the right, again, like accountants, we have different sales tax partners. Some are more conservative, some are more aggressive. Some just do software, some give advice, some don't. So we place you with the right, based upon your situation, the right person. So why is behind in sales tax an issue? Worst case scenario, if you audit, could be paying the sales tax out of your own pocket, plus penalties and interest out of your own pocket. That could add up to 10% of your sales. Let's say you did 200,000 in sales in a state. That could be 20 grand you owe to the state that you should have collected from your customer, and they should have paid it, not you. That's why this is an important subject. So every day that goes by, you're not in compliance. You're literally flushing money down the toilet, and you want to avoid that. Let's look at the subject nobody wants to talk about, U.S. state income tax. So we got to understand tax nexus. So when physical presence becomes a tax trap, nexus definition, sufficient connection requiring tax filings and payments in a state. Amazon FBA sellers typically have a physical nexus due to stored inventory. States can require foreign registration, annual state income franchise tax returns, payment of state income franchise taxes separate from sales tax. Important to know, states' income tax obligations apply equally to foreign entities and U.S. entities. So you're not off the hook if you're a foreign entity. You may be subject in some situations to a state income tax separate from sales tax, even if the marketplace is collecting it. U.S. tax treaties do not protect against state-level income taxes. That's the big issue with sales tax and income tax in the United States. Even if you're from a treaty country, you're not protected. So we got to take a look at California, one of the worst states to do business in the country. California has a physical nexus threshold that's separate from the 500,000 economic nexus threshold. If your average inventory exceeds $69,015 in 2024, this is looks back at the past years, indexed annually, mandatory foreign registration with the California Secretary of State. So 70 grand inventory in California, mandatory registration Secretary of State, pay minimum franchise tax fee of $800 kicks in. Just for good old California. You got to file annual state franchise income tax returns. Practical example, inventory stored in Amazon's California warehouse, average annual value over $69,000. Goes up a little bit each year. Foreign registration mandatory, annual $800. Possible additional state tax on net income apportioned to California. California corporate rates 8.84%. Common states known with FBA nexus enforcements. These are a few states you have to take a look at. Texas, Washington, Pennsylvania, Illinois, New Jersey. So these are a few of them. So are you safe or at risk? Smaller sellers, 100,000, 500,000 annual sales, often skip compliance due to complexity, low audit risk. They're not going to pay, anywhere from 5 to 7 to 13,000 a year for sales tax compliance, just for zero returns and a Washington and Texas tax return and maybe a California fee. They might roll the dice on filing, but exposure does add up fast. Larger brands, 10 to 50 million, they got to be in compliance. They're a brand. Compliance is a big part of everything they do. They do it on the product side. They got to do it on the tax and compliance side. Most comply due to audit risk, brand equity, and exit goals. They certainly don't want to be in the newspaper for not being in compliance, or newspaper online. Non-compliance equals penalties, interest, and reputational damage. Risk isn't just about size, it's about goals and visibility. So, treaty or not, states will want their cut. So that's an important distinction. Again, we talked about it. Some people say, I have a treaty, I don't owe any U.S. tax. Truth, that's the federal level. There's no treaty, though, at the state level is where it hits you. So states, in most cases, there are some states that will follow and honor the federal tax treaties. FBA inventory equals state level nexus, must register, file tax returns, pay state specific minimums. Bottom line, federal treaty does not equal state protection. If you're storing inventory in the U.S., you are exposed. California does not honor U.S. federal tax treaties. So that's where I have the note there about California. Expert classification on state exposure. U.S. states do not recognize U.S. federal bilateral tax treaties, even if no federal income tax is imposed. This is more on the same subject to drive the point home. This was a quote by Sylvia Dion. She's the first person I went to back in 2015 to find who's the guru on SALT sales tax in the United States 10 years ago. And that was Sylvia Dion. We did training, we did a webinar on it, and we talked about the differences between federal and state law and why these things were different. Now let's talk about optimized company formation. Who you are determines what you need. You might be in the first group. You're a non-resident entering or expanding in the United States. You have two paths. You can sell through a foreign entity, need an EIN address, IRS tax filings, trigger certain federal state compliance. If you form a U.S. company, often better for banking verifications, brand, and trust. Either way, you must align with the marketplace, TikTok Shop, Amazon, some of the rules we talked about, right? Requires a strategic address and formation decisions. Now, most companies need two addresses, non-CMRC and a CMRA, which is a commercial receiving agency. Think of a virtual address that forwards mail for you, because of FinCEN, the tightening when you have a U.S. company. We handle all of that. We do have partners in some things we don't do, but we advise upon it, and we tell you when we need a partner, what we can do in-house. That's how our process works. And we have services to evaluate before we make any recommendations. We don't make any recommendations without an evaluation or strategy call first. That'd be like going to a doctor and say, my shoulder hurts, and just give me a prescription. They want to diagnose you first, then go from there. We take the same approach. Group 2, if you're a U.S. resident, you're already U.S. based, obviously a little bit easier. You decide which entity is going to be best for you. The S-Corps come into play. Remember, single member LLC first, maybe convert to an S-Corp by the end of the year. Where to form it? Do you do it in your home state, most common? Do you do it in Nevada, Wyoming? Do we need to foreign register? Is there any added advantage? Even if you have two state fees, all that comes into play. consider state income, franchise tax, future exit or growth plans, marketplace and tax alignment. All those things need to come into play. So your platform and tax strategies drives the structure, not the other way around. Most, they just go form an LLC and they set up something. Okay, I'm stuck here. Well, okay, let's take a few steps back. What were you trying to accomplish? What was your goal? Can we use that entity, amend it? Should we start from scratch? All of that just slows down the process. Better to do it right from the start. So before you form a U.S. entity, take a step back. First, decide when and how you sell. Marketplace, non-marketplace, or hybrid. The decision dictates where you use a foreign entity, U.S. entity, or both. Then and only then you select the address, strategy, formation state, banking route. The wrong order creates complex risks, bank rejections, and tax exposure. Structure allows platform and tax strategy, then build your entity and address around it is the approach. That's the bottom line. So that's what you want to keep in mind is when you're putting everything together. Wyoming versus Nevada, you're asking the wrong questions. I guarantee it. Not guarantee. Some of you are going to be asking better quality questions. Most sellers ask the wrong questions. Most get caught up in privacy versus public records. Who's cheaper? $100 a year. I've seen all the different Facebook groups, different groups. I did mine for $39. I did mine for $29. Mine was free for 6 months, and it's just the wrong approach. What other sellers do? They just look at that. They just assume everybody's in the same boat. I'm in an Amazon FBA Facebook group. What did you do? Like, really? That's just not the approach, but I know it happens. So here's the truth. If you're selling a TikTok shop, you'll need a U.S. entity with the ultimate beneficial owner owning more than 25%. And that has to be an individual, by the way, so that doesn't mean your foreign company can own 100% of the U.S. company for TikTok shop. If you're using a foreign entity, you may not need a U.S. LLC at all, not for TikTok shop, but in general. Formation state impact. So where you form affects it. Franchise tax, I just talked to non-residents. They form their company in California, C Corp. Not my recommendation, but that's what they did. They have the franchise tax fee, 8.84% federal or state taxes. You have to look at next exposure, registered agent address strategy, future banking marketplace. The bottom line, don't pick a state, pick a structure that matches your e-commerce expansion strategy. So I've said this a couple different times. Just want to reiterate, this is what you need to do. So we can help you form it where it makes sense. There's always exceptions. There's always little nuances. So just because your friend did Nevada or your friend did Wyoming or your friend did Delaware doesn't mean it's going to work for you. There might be a reason why that maybe it was easier, simple. Maybe there's a special offer. Who knows what the reason was at the time. We need to look at currently what's going on, and things do change. So we do incorporate in all 50 states. We have a registered agent partner for the states we're not in. So we're open to all the above. Just some things are more difficult than others. Think like a business utility bill. Doesn't come into play as often as most people think, but when it does, we can only do that in Nevada. So fixing it later costs more for sure. Rushing in the wrong LLC structure, you pay for it later. Mending the manager, the member structure, the fees, the delays. Disregarded to a corp, IRS filing, state level changes, change the IN ownership, entity type, full rework. Some states require new filing entirely. We form LLCs the right way first based upon marketplace tax and banking strategy. And of course, banking is now it's more dictated on your address strategy. Then we have to look at the permanent establishment, all that kind of stuff. So your expansion strategy checklist looks like this. Before you form a U.S. entity or expand with a foreign entity, ask what platforms am I selling on? Obviously, the marketplace, direct-to-consumer, hybrid, and am I starting as a foreign company or a U.S. company? Are you expanding to different marketplaces too? Of course, when are you expanding? Could that be a different entity? We should probably know that up front. Do I understand how many U.S. addresses, how my U.S. address can impact tax and verification? I talked about that a little bit. If my structure is built to support the IRS state filings, banking, Stripe, Payoneer, setup, marketplace onboarding, will this structure scale as I grow or sell? We help sellers and advisors answer these questions before the paperwork starts. That's what we do. And our team is all over it. We have, again, we don't have a simple form for LLCs that asks 4 basic questions. Ours is a little more complicated. There's detailed instructions. Our team reviews it. I review it. We compare it against the notes, based upon the strategy call to make sure everything lines up. Our team is often double checking, did you change your mind because you now want to be an LLC taxed as a C Corp versus a partnership, because that's not what our notes say. Our team is on it like that. They're not just going to go, oh, well, that's what you filled in, so that's what we filed. It's on you. We don't do that. So that's what's going to happen when you do it other places. What verification really takes, whether you're expanding through a foreign company, a foreign US LLC, you need core documents, passport. Passport's a big one for some people, because in order to get an address that'll forward mail, think of your debit card, we need to be a CMRA. That requires Form 1583. Are there some companies that aren't doing that? They're running a great risk by not doing that. If they're receiving mail at that address, I would avoid them, because you don't want them to be part of the post office taking a look at them. So be very cautious. So we need a passport to get to 1583. It's an online notary situation. Just saying that's one of the key documents. Personal proof of address on your side. This is a big problem for a lot of people. I won't go down all the details. We have a ton of PDFs and bonuses that go through this. We have alternative options. We have to reverse engineer that stuff for banking, address verification. What are your best options? How to move forward. Entity EIN letter that must align with address and name for TikTok. Not as much for Amazon. They want the LLC and EIN to match. So there's differences. I will say, if you're from a restricted country, and you can look it up, like if you reverse engineer Mercury, Relay, restricted countries, and you are one of those, we're not going to be able to help you. We don't do tips and tricks and hacks and shortcuts to kind of trick the system. We just will say, unfortunately, we're not able to work with you. We do that for a reason, because we don't want to take that on to have undue scrutiny on our company and our clients. So we just avoid that. So unfortunately, if you're in that situation, we're just not able to help. And I understand you may be in a desperate situation. There's other companies that will do that kind of stuff. We just don't want to put our clients at risk by doing that. U.S. virtual address. Again, if you're receiving mail to the address, must be a CMRA compliant proper setup. Business utility bill, usually not required. It's usually caused by mismatches, and it creates a bunch of delays. Costly mistakes in time and money is inconsistency between names, between EIN, passport, and addresses. We had an Australian client that on his bank statement that he was going to use for verification, it has initials, last name, but on the account had his full name, got rejected. So these things happen. Missing notarized form, that's an issue, right? Trying to fix this after formation, costly restarts, especially with Amazon. They just think you have no clue what you're doing. They just ignore your same appeal, your same copy and paste. That's when you got to refer you to, people like Chris McCabe at e-commerce Chris, and you're going to spend, maybe $4,000 to get it fixed. So again, it's better to do it right from the start. Verification is about alignment, as we talked about, not just documents. When you structure your address ID match from day one, you launch faster and scale smoother. That's really about what this is, and that's what we handle in the big picture, full circle. We're going to talk a couple of strategy insights here on structures. I won't go into all the details, but we're going to talk about a U.S. LLC taxed as a C Corp owned by a foreign individual from a treaty country. The U.S. LLC taxed as a C Corp will file Form 8832 if it's an LLC, files 1120 and 5472 if it's more of a 25% foreign owner. It's going to pay U.S. taxes at 21% tax rate. So it's already a U.S. person, already paying taxes. Doesn't matter if you have a P or ECI or any of that stuff, because you've already volunteered to pay taxes in the U.S. by a C Corp option. So that's how that works. Okay, so now let's change it around and say multi-member LLC taxed as a corporation. Very similar. You used to have a two-member LLC, and it's the same result. Sometimes this comes into play for TikTok Shop, things of that nature. We just have to look at the UBO and the percentage if it's a foreign individual or foreign company. Now let's look at an LLC taxed as a partnership. Some people do this because they don't want the C Corp, they want the partnership, and they think the partnership won't be subject to U.S. taxes, so I'll go that route because I can still claim I don't have BCI and all this good stuff, and you got to be very careful. So there's a lot more involved here in partnerships that you determine. The big thing you got to know is there's a withholding of 37% for individuals if there's ECI and 21% for the corporation. Both can be refunded if possible. Returns are filed from treaty countries and all the proper forms are filed correctly. Most people assume I'm not in that situation, they don't do it properly. So there's a lot involved in partnership taxation, getting it right. Obviously, if you have a permanent establishment, it's a different set of the rules and not getting a refund and paying the U.S. tax. You're from a non-treaty country, this is even more important to get right. So very important with partnerships to make sure everything's done properly. So let me give you a case study that you can cut the tax rate in half. Obviously, there's different pluses and minuses, different ways you can look at this. So this is a situation where a client had a profit of $1 million. Country of origin is Hong Kong. Initial structure was a Hong Kong company directly owned by a U.S. single member LLC. There's no tax treaty. It's on Amazon. TikTok shop isn't. They could sell that from the Hong Kong company, so that's why it's not the single member LLC is not a C corp. Amazon FBA stock warehouse physical nexus TikTok shop primary business representative. Again, that one's a little different here. I would say that might be more of a typo because we'll be doing that. Hong Kong and China are the only two that you can sell in the U.S. from those two countries. So the key is this permanent establishment issue. The initial structure created significant tax exposure. Permanent establishment related to foreign company in Hong Kong. IRS determined inventory plus U.S. returns. Process created a dependent agent under the new rules, the OECD rules. If that would happen, what happens, you have corporate tax 21% on the net profits. Branch profit tax is on the remaining profit. So if we take 21% times $1 million, pay 210, you have 790 left times 30%, and there's no reduction in branch profit tax. So now you have another total of 237 added. So the U.S. total tax liability is $447,000 at 44.7%. That's horrific because there's no treaty, branch profit tax not reduced. So restructuring, what could be done is set up an LLC C Corp and eliminate the stuff about having a permanent establishment branch profit tax because the income's already taxed in the U.S. Now it's taxed at 21%. But if the Hong Kong shareholder later decides to take dividends, which if it did, that would be taxed at the 30%, what's called FDAP tax, and there's no treaty, so that's 237, unless they plan to leave their profits in U.S. corp or restructure later. The immediate tax drops from 47.7 to 21. So deferring the additional 30% until funds are reinvested. The summary: by operating through a U.S. corp, the business pays the single 21%, avoids the immediate 30% branch profit tax, assuming there was a PE in that situation coming into play. And if there's ECI with no treaty, they're going to have to pay the 21% tax, and the branch profit tax has to be considered also. So this is a strategy to keep in mind and to consider. Again, most people are in China with a Hong Kong company selling on Amazon. They just assume they don't have a U.S. trade or business ECI, and they're not filing anything. Sometimes people will file an 1120F protective return. There is no 8833 because there's no treaty. So if they get audited and the IRS disagrees with it, they want to look at that. So we've worked with some tax attorneys that take that position. So it's very complicated. Again, you want to talk with your tax professional in your country, work with a tax attorney we could recommend, make sure you get everybody on the same page. IRS and state penalties, we won't go through all of these, but all these particular forms, like the 8833 for a corporation not filed, it's a $10,000 fine. That's per failure. So you have to look at these fines, how things can add up. If you're supposed to do a 1049-R, pay taxes, it can add up quite a bit. So that's an important distinction to keep in mind. So you got to get this right. Compliance levels: non-resident companies selling in the U.S. face a nuanced, multi-tiered obligational framework. We talked about sales tax, franchise tax, corporate registration, income tax. Most sellers miss is, as we talked about, in summary, most sellers miss these taxes because the CPA and I worked with a group of them. Some focus in specific areas. Most do not focus in this area because it's more expensive, more complicated. So we work with those that work at a higher end. We talked about these misconceptions. Which one do you make around U.S. Trader Business, ECI, PE, the new PE rules that are coming to play? Are you going to be subject to double taxation? Potentially, that would be a problem. You're selling through a foreign entity. Are you still off the hook? Are you not? Selling through a U.S. company, what works, what doesn't work. We talked about sales tax. Even as a marketplace seller for bigger brands, we work actually with big e-commerce compliance companies in Europe that refer clients to us for the U.S. side to get in compliance on all these things. And we have our partners, so it's a seamless process. U.S. state income tax is one that is another layer, gets a little more advanced. And then we talked about that one particular case study of a potential structuring issue, how to look at it. Everything has pluses and minuses, is not perfect. You still eventually, if you take the profits out, you're going to have some tax later on with the USC Corp. That's where you'll read a lot of content about USC Corps and double taxation, right? So we do have to plan that out. So not everything's perfect, but you do have to be aware of the big picture, how that works. So your next step is, if you need support, you're going to see that we demonstrate a lot of different areas. That's me and Chris McCabe at an Amazon event. That looks like an event on, could have been the Prosper Show. You want to get clear on your goals, your platform mix, and your marketplace exposure. Then bring your CPA tax pro and one of your vetted experts. But get them all on the same page. That's critical. And sometimes when people work with us, we consult, they want to form the entity, we put the brakes on, there's questions by their tax professionals, then we go back and forth for a week or two. We got everybody on the same page, we get the green light, then we move forward. It's always better to do that. Sometimes it takes 30 days to move forward. So you got to plan far enough in advance, knowing that if you want to be up and running 2 or 3 months from now, remember what even Amazon said, 2 months to get verified. If you make one mistake, it could be that long. So just plan ahead. Yes, I know you see headlines, oh, you can form an LLC in 24 hours and you can form it online, it's easy. That's just one piece of the puzzle. That's part of this whole thing. But you want to get everybody on the same page before doing anything in the US or with your foreign company, because here's the truth. Most of the biggest tax messes I fix are from trying to expand or get a new account verified. They go too fast and they just don't have a plan. And they thought it was simple. They saw somebody else do it, and they just said, okay, I'll just do that. And it rarely works out that way. The wrong structure equals higher taxes and platform risk. Let's get it right from the start. How do we do that? Get it right from the start. You can schedule a free fit call with my advanced team. You can go to nvinc.com/schedule/. You'll schedule a call with them. What they'll do is want to get clarity on your situation, ask a bunch of different questions. And try to assess what stage are you at in this process. And based upon what stage of process, we have different entry points into some services. A lot of them start with me in a strategy call. Some will go to a package that includes strategy calls. Some we're going to map out a complete plan first before you do anything. Some may have just need support with TikTok Shop and their primary business representative that they've identified in the United States, but they don't know how to get them on board or set up the account. So there's different pathways. What we don't do is just a la carte. Can I get an address from you? Can I get a bank account from you? We don't do that. We do as I said earlier, like going to the doctor, we do an evaluation first. Then once we do the evaluation, the diagnosis, then we make recommendations from there. So the first thing is to find out more about your situation. That's step one. That part's free. We don't give advice on that call. And then they will let you know what entry points, and then how do we go from there to work in our infrastructure and to get access to our network, our referrals, our trusted partners. You got to become a client first. That starts with a strategy call at a minimum with myself before we get introductions, things of that nature. This is one of our tax attorneys that came to Las Vegas recently at the Wynn Casino, Mark Schwartz. He's out of Georgia. He's does large clients doing hundreds of millions of dollars in multiple countries around the world, especially in Latin America. He speaks at conferences around the world. And so that's one of our trusted resources that we work with. So we look forward to working with you. Again, my name is Scott Letourneau. Reach out, schedule a call with our team. We'll take great care. If we can't help you out, we'll let you know. If you're from a restricted country, we're just not going to be able to help you. We don't do tips and tricks and shortcuts and things and hacks to get you in. We're just not about that. There's a lot of YouTube videos that do those kind of things. We're looking for those sellers who are serious brands, want to be protected. And even if it's a second or third opinion, you want to get us to take a look at what's been recommended. Keep in mind, this is a moving target, especially the tax with the IRS, the administration, FinCEN. These things are changing sometimes on a daily, weekly, monthly basis. So that's why even if you've listened to this, we need to always do a current check before you move forward. And I would recommend you talk to our team, and then in a lot of cases, you'll be talking to us, or we'll move forward with a package that includes my time. We do strategic email coaching also. So we look forward to working with you. Again, my name is Scott Letourneau, and have an outstanding day.